This is Alan Bush with ADMIS with the daily financial forecast for Thursday, September 24th. In the stock index futures, we did open lower. I think this is in anticipation that Fed Chair Yellen's lecture at the University of Massachusetts this afternoon at 4 o'clock Central Time may contain some hawkish commentary. This is likely to contrast what she had said at the press conference after the Fed meeting last Thursday. If you recall, last Thursday the Fed did not raise interest rates. They were rather dovish in their commentary, and yet since then several Fed spokesmen had very hawkish comments, and I think that Janet Yellen may fall into the same vein. So traders are anticipating some on-balance hawkish talk from her when she speaks this afternoon, and that is, I believe, the main reason why we are seeing lower prices today for stock index futures, and it may be difficult to rally at least today with that potential negative overhanging the market. Longer term, though, we do feel that any weakness in the global economy will be met with more accommodation. In fact, just overnight we had two central banks, the Central Bank of Taiwan and the Central Bank of Norway, both cutting interest rates. Other central banks, larger central banks, we think later this year and into next year will also be adding more accommodation, and that will ultimately rescue this stock index futures market and take prices higher. It may take a while. In fact, it will probably take a while, but higher prices are likely ahead next year. In the currency markets, we're seeing the euro currency higher. This due to better than expected economic numbers out of Germany, with their business confidence index unexpectedly increasing, so the euro advancing. Also, we are seeing lower prices in the Australian dollar and the Canadian, especially in the overnight trade, as energy prices were weaker then. In fact, the Canadian dollar declined to an 11-year low. Longer term, we feel that the dollar index is probably going to work lower, and this is very much a minority view, since most analysts believe that the Fed will be raising rates later this year. Our feeling is that the Fed will not raise rates. So from an interest rate differential point of view, the dollar is likely to work lower. And in the interest rate markets, we are seeing futures sharply higher, especially at the long end. Some of this is flight to quality buying in light of lower stock index futures and weaker commodity prices, even though we do have some supply today with the Treasury auctioning $29 billion in 7-year notes. So a trend toward, I would think, slower economic growth globally is likely to support the interest rate futures markets, especially at the long end. Plus, we also feel the Fed will not be raising rates, and that is also a major supportive factor for the interest rate futures markets longer term. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.